Hello guys and welcome back to Invest with Humility. My name is Bruno and on this video we'll be discussing the different players and how you're going to trade against the different players. In the last model we have talked about the book and how it affects the prices. So let me ask you this. Imagine you knew what other people wanted to do. It would be easy, right? It will be easier for you to predict where the stock is going to go to. So again, with the same example that we have covered previously, imagine if you knew a stock which had 75,000 shares in float, and you knew someone or an institution which had 40,000 shares of that company. So he owns the majority of the shares. Now imagine that you could have known that this person wanted to sell some of these shares. You would know that the price might drop because such a big player who has so much shares, if he wanted to sell, um, would have seen that the prices is going to fluctuate because of this order. If he sends an order to sell, the price will fall. Now, different players trade differently, and this is something that you have to understand. A mutual fund or somebody who has a lot of shares is not going to trade the same as somebody sitting at home, a retail trader. So when we're looking at different players, these people, these guys, right? These guys, this is their profession. It's not like a retail trader. Some of them, some retail traders who are super good, who are really dedicated to this, but most of a retail trader are trying to do this on the side, and some are super committed to do it full time. So you need to understand that when you get in, you need to understand different players so that you can understand your hand and how you could be able to trade, or else you could be a target because all these institutions, they look at retail traders or people who do not have a lot of tools as easy to win their money, and you do not want to lose your money because you need to understand all this is a zero sum game, meaning for every dollar, every $1 you make, someone else lost it. Okay, so please be aware of that, and just follow along and understand all these things that we're discussing on this course so that you may be prepared. If you're really anxious to get your hands in there, you can start to do some paper trading, but please, please, please do not put your hard-earned money because the market is a brutal place. You'll be humbled really quick. Okay, all right, so let's proceed with our discussion. Okay, again, the same thing in poker or in different sports and in different sectors. Different participants participate differently. So in this situation, if you knew that the person has a big mutual fund, has 40,000 shares, what could you have done? You could know that as a mutual fund or a big institution, he's going to try and sell his shares when there's good news, because that's the only time he's going to be able to unload some of the shares. So you need to understand, for example, for this big mutual funds or hedge funds, they're known to sell on good news. So they will establish their position a week or sometimes a week and a half before they know that there's going to be good news, either if these are earnings or they just anticipate there's good news coming to that company, which is going to be announced. They will take something which is undervalued or which does not have news at that particular time. It could be even longer, and they will offload in situations where there's good news. So you should be aware of their strategies, and you should know that these are the big players. So when they offload a lot of shares, so it's really going to impact the trade. Even though good news is coming, if they offload the shares, you will suffer because the prices has sharply gone down, unless you get another mutual fund which is going to buy all those shares all the way up again, which sometimes it happens, but it rarely does, unless depending on what's happening with that particular stock. Okay, so he can't sell the shares when the stock is going down because he will make the stock tumble. So he has to wait when there is a good news for them to. Um, so he has to wait when there's good news for the buyers. So he has to wait when there's good news for there to be enough buyers so he can sell them those shares and unload the shares. Okay, so if you knew there was a big mutual fund and he wanted to sell all the shares, you could have sold in front of him. And if there was good news that comes out, you're not going to buy right away. because you know that there are the sellers. And this is why a lot of times you're going to see a stock that has very good news and then it's going to drop 10%. And people aren't going to understand why the news is good. Why did it drop? Well, maybe because a big mutual fund wanted to sell its shares and they're known to sell on good news. So it wouldn't have been, would it be helpful for you to have known that this specific stock has a lot of institutional ownership, has a lot of mutual funds and hedge fund ownership? Yeah, it would have, right? And this is the information that is publicly available, but it never ceases to amaze me on how people don't talk about it. And some people might tell you, well, I have this stock, and I ask them, what institutional ownership is on it, and they would answer, I do not know. Well, how can you not know? You're trading the stock. Wouldn't you be better if you knew who you're trading against? Because at the end of the day, trading is a zero-sum game. And what it means is that for every dollar that you make, someone else has lost it. Okay? So you want to know who you're playing against because that's the person you're taking money from. Same thing in poker. If you will play at a poker, you are going to be at the top level with all the top level poker players. You're extremely experienced, and this is at the top level. So what do you think differentiate these players? They all know how to calculate probability. They can calculate the same odds of how much they can win or lose or losses they're going to have. So at this point, what differentiates them is really minor things. So when they're going to be playing at this high level, they study the other person that is going to be playing against them because they're all at the top level. They all understand each other. They all have the same skill. So what are the key things that they look, the differentiating factor? So they will look at, what is this person's style? Do they bluff a lot? How do they play? How do they call? So that way they have every advantage they can have. Same thing in sport. If you have got to the finals and how you're playing against a team, you're not going to just practice as if it's a regular basketball game. At the championship level, you're going to practice specifically for that team because they're going to play in that particular way. So you may also have seen this in, like, playoffs, when you get to the finals or even in different playoff series, like a coach is always making adjustments. All these teams are really good, but they know that if they go to the next game playing the way they played in the last game, they won't have the results that they have because the other team has also already looked at the footage and prepared for how the team played, so they should make proper adjustment. It's an ongoing game. It's not like a one-time thing where you set something up and you're good, forever. You have to make adjustments periodically so that you can be on good standards when you're going to face the other person that you're going to face. So same thing as stocks. Prices are going to move because of the buy orders and sell orders that people are sending, or the participants are sending. So you got to know who are those participants because they're going to send orders in a different types of manner. So that being said, for every stock that you're going to trade, you want to know what is the institutional ownership of that stock. Is there a lot of institution that owns that stock? Like Facebook is 70% or higher, or does it have no institutional ownership? So there's a lot of things that you have which have zero institutional ownership. So it's all retail float, and all retail people are buying it. And this talks, are really targeted by big mutual funds because they look at it as easy money because most of the retail traders do not have enough tools such as mutual funds, hedge funds, proprietary firms to like understand, to look at different factors and evaluate different things, or even algorithms which can trigger the buy or sell on their end, as when you're completing, as opposed to like retail trader who is just using Robinhood or Webull. So of course you'll be on a disadvantage there. So low institution retail are going retail are easily likely to explode in this direction, and another because of good news. So retail are just buying, they're not going to offload on good news, and for different reasons which we'll cover more specific in another model. But keep in mind that this is something that you're always going to have to watch out for the players that you're playing against. Now really quickly, who are different players? Which So the different players include proprietary firms. So these are considered smart money. So they're trying to take advantage of small inefficiencies in the market, get in and get out quickly. So you can see these firms in many places. You can also see some of them like on YouTube, like Trader TV Live. So these are the guys who are really trying to take advantage of, the small inefficiency in the market. They see a good price, a stock is good, they'll get in and get out. Please do not follow their trades, because most of these proprietary firms, they do not hold. They do not tell you their positions or their trades that they hold if you're an investor. So if you have an intention of buying the stock for the purpose of holding, please do not follow them. You'll be burned, because their goal and their way they make money is by getting into a stock and getting out of it as quickly as possible to make that difference. Okay? When they make the difference, that is good. They just count the dollar amount, because you need to understand, when they make 10 cents or 20 cents or 30 cents, it's a lot of money, because they have a lot of investors' money poured into it. So they're investing in millions. It's not like a retail trader where you're investing in like a small amount. So you really have to consider all those things. Okay, so these guys have a lot of tools and information and access to commission and fees, so they're very competitive. Another type of players are investors. Now investors, they come in and buy stocks and they keep them for a while. Okay, so they're going to trade, they're not going to trade, they're going to put in the money and leave it for a longer period of time. You have your retail trader. Now retail traders, which are these people here, so these are the retail traders here. Now retail traders are traders who trade for the market, who do not have a lot of sophisticated tools and information or strategies. Now these people are considered dumb money because it's easy to make money. So please be careful. Please be careful. I recommend practice paper trading before losing your savings. Okay, because in the market, all sophisticated traders are looking at retail traders. They're looking at these guys to get money from. They want to take your money. Okay, so all these guys, they're looking at retail traders to take their money. So be really careful. Okay, so as a professional trader, or as a professional, or as somebody who does this in a smart manner, you want stocks that have a lot of retail flow, because again, you're getting money from someone. So you want to play against people who aren't as sophisticated as you. So you need to understand, when you get into the market and you're trying to make money, you are a target as a retail trader, because they consider you do not have all of the sophisticated tools that most of these big players have. They have tools and they have experience. So here, experience and tools. These players, okay, they have tools and experience. So keep those things in mind. Okay. So portfolio manager, which are mutual funds. So these are big funds. A mutual fund is a big fund that people put money in and has a portfolio manager. The portfolio manager oversees the funds and buys and sells stocks with those funds. So it could be different millions of dollars following a prospectus that the client agree on. So he might say, I'm putting 20% in financial stock, 20% in gold stock, and he's going to fall back, but he's going to pick and choose the stocks that he think will make you the most money. Mutual funds haven't been performing very well in the past. They actually perform the worst than ETF, and we'll cover ETFs in more detail in another module. But if you put your money in the market, you're actually outperforming a mutual fund. And the reason for that is because mutual fund, the portfolio manager, take an expenses ratio. So he takes a fee every year about 2%. Okay, in this kind of adds up. It takes away from the money that you actually could have been making. So mutual funds aren't really good to put money in. You're better off the time that you select a stock, even if you're an investor, but it is one of the big players. um, but it is one of the big players, because mutual funds are going to buy a lot of shares in a company, and when they sell a lot of shares. So you're going to have to know about that, and you can know which mutual funds has which stock in their holding, and you can know how you're going to trade those stocks just by knowing that they have it, because it is known that when mutual fund have a stock that's been performing very well, they're going to try and remove money from the stock to take some money off the table, take some profit off the table and put it in something that is still undervalued and that's not overvalued anymore. So we can guess what other players are going to do. And by guessing what other players are going to do, we can guess what stock is going to do. Because at the end of the day, you're trying to guess where the stock is going to go to. You're trying to guess what other people are going to do, because what other people are going to do is what is going to drive the price to go to the direction, to either bullish direction or a yeah. So don't try to look at it like, is this not a good stock or is this not a good company? What you want to do is try to predict how are other people evaluating the stock. That is the most important thing. We want to know how other people are evaluating the stock. So this is the most important thing. Just like all the things we have spoken about in this video, we want to consider how other people are evaluating the stock, because this is going to drive either the stock to A, bullish direction, or B, bearish direction. Okay? So as we have discussed, we want to know how other people are evaluating the stock, because of that evaluation, that's what's going to drive their orders. And because there are orders, that's what's going to drive the prices. And you want to know what other people are going to do from now on and in the future. Other types of players is the hedge fund. Hedge fund are smart money. They're like mutual funds, big capital. Not anybody can put money in a hedge fund. So you have to be somebody who's rich enough, because there are very strict minimums, and hedge funds can do more than mutual funds. So they can go long or go short, which we're going to be covering in the future in another module, which we'll cover. So hedge funds can do all of that. They are way more sophisticated than mutual funds, and they're way smarter. They tend to make more returns, and they are very discreet. So we can't really know the position that they have up until several months after, when it's too late or when they've already traded the stock. Typically, you won't know what the hedge funds are doing. They can be really secretive, and they can allow you. For some hedge funds, they can be really transparent. Like Cathy Wood, can be really transparent, and you can know this information. But most of them, you really can't know what they're doing. So hedge funds, we can't really know about it, about their decisions, but these are the top players. And for every stock that you're going to trade from now, and every strategy, you're going to look at institutional ownership and base your strategy on that. Okay, so this concludes this video. I hope you understood the different players and why it's important to know who you're trading with, because at the end of the day, it is a zero-sum game. Please protect every dollar that you have, because I know most of you learning this on YouTube, you're just learning this to make some extra bucks, and it's good. It's very true that you can make money on the stock market, but you need to be prepared. Be prepared so that you can get better results. All right, that's it. That's it on this video. Thank you for your attention. Thank you for watching it. Please leave your questions below. If you enjoyed the video, please give us a thumbs up. Until the next one, be blessed, and see you soon. Bye.